Hello, my name is Andy Lowe. I'm a manager in the Business Valuation Litigation Support Group. I run our Knoxville office valuation practice. We've got valuation practices in all three offices. All three offices work very closely together, but I am in our East Tennessee office.
We sat down with Andy to sort through the complexities of non-competes, intangible and tangible assets, and valuations. He makes it easy and walks us step by step through the process. Enjoy.
I joined LBMC a little over 6 years ago and came to them out of the real estate development business. So found LBMC through a friend of a friend, and they had a need in their valuation department. And my real estate position, I was an investment analyst, deal bird dog, if you will, for the real estate group I was working with. And I quote, valued a lot of real estate transactions and opportunities on paper. And so the underlying fundamentals of valuing an operating company versus what I was doing at the real estate shop, there was a lot of common ground there. I guess the fundamentals were very similar. And so a couple of conversations and made sense to me, and it's been great ever since.
So much of that was actually focused with tangible things like real estate.
Correct.
But now you're in something that's intangible, right? So how did you find yourself going from one end to the other?
You know, when you value a company is made up of all sorts of different assets. You've got your current assets, things like, and I'm referring specifically to the balance sheet. You'll see a company that's got cash and accounts receivable and inventory, maybe some prepaid items, all sorts of different things. Then as you go on down the balance sheet, you might see things like fixed assets, trucks, tanks, buildings, whatever the case might be. But then oftentimes you see this big catch-all bucket called goodwill, and everybody wonders what goodwill is. Or you might see goodwill and intangible assets. Well, what is an intangible asset? What is that comprised of, and how does it even find its way onto the balance sheet? Well, what we are often engaged to do is value a business and allocate. Let's before I go there, let's say that we have a company buying another company. Okay, so company A buys company B. Company A has to put all the assets that they purchased onto their balance sheet. Now, company A is not just going to put company B line item on their balance sheet. They're going to actually allocate it among all the assets that they purchased. And so what happens is the tangible assets are very easy. I bought this business and they own $5 million worth of real estate, $5 million, land, buildings, whatever you might want to put on there. They might have had $10 million of accounts receivable. So $10 million of accounts receivable goes on the balance sheet. Inventory and other different things go on there in that tangible value very easily. They transfer from one company to the other. Intangible assets, though, are a little trickier, and that's when we get engaged by our clients to go in and actually assign value to things like non-compete agreements, technology, internally developed technology or software, goodwill. I mentioned the goodwill bucket earlier. That'll be a residual. We value things like in-process research and development, trademarks, trade names, all sorts of different intangible assets.
So as we now focus on non-compete agreements, what is the real secret sauce or the real difference between why that can be such not a mystery, but it can be a little bit different as you're thinking about an intangible?
With the non-compete agreement, it's something that everybody seems to have these days. You start to work for a company, they make you sign a non-compete agreement. You sell your company, you're signing a non-compete agreement. It seems like everybody's subject to some non-compete agreement out there somewhere. And quite frankly, a lot of us sign them and just keep moving, never think another thing about it, just because they said if we want to work here, we got to sign it, or if we want to sell our business, we got to sign it. And so, we don't give a second thought to it. Interestingly, though, to my example earlier, when we are valuing the intangible assets of a company after a transaction, we have to actually assign value to the non-compete agreements that were generated as a result of that transaction. So What we do is we value the non-compete agreements using what's called a with or without methodology. And essentially what we do is we look at the forecasted results of that company with that person in place, okay? Or maybe I should say it this way, not competing against the company. Sometimes they're working in the business, sometimes they're not working in the business, but either way, they're not competing against the company. What does the future cash flow look like if that person is not competing? Then we make the assumption that the non-compete did not exist and the person is competing. And what happens then? Maybe they take 10% of revenue, maybe they take 50%, maybe they're a sales guy and they've got all these relationships and they can take 50% of the revenue. What happens if the guy's competing and as a result he actually leaves our company? Would the company we're dealing with replace him? Could he be replaced at a cheaper price tag? Did he have a high inflated salary, for instance? Would our company ramp up their advertising and marketing dollars as a result of this competition? So we look at not only the revenue side but also the expense side of what changes would happen in the future and determine the cash flow generated assuming the competition. So you've then got two buckets, two sides of this coin: the future cash flows of the business without competition, future cash flows of the business with competition. You bring both of those back to a present value, and the difference is the value of that non-compete. And you've got to certainly consider things like, what is the probability that that individual would compete? What is the likelihood that he or she could actually take the revenue that we're assuming they can take? What's the probability that they could actually be successful at it? And we consider things like, maybe the guy that just sold his business is 75 years old and he bought a condo in Florida. Is he likely to compete? Probably not.
Right.
This is a retirement situation. So chances of him competing are very, very slim. You might have somebody else that's a serial entrepreneur and he's started and sold 3 businesses and the guy's 42 years old. I can all but guarantee that if that non-compete were not in place, he would likely compete, if the non-compete were not there. So, all of those things kind of play into the decision process and the likelihood that this would actually take place.
So from your experience with this, what do you think are some of the most common mistakes and maybe this is on the company side, maybe this is on the person who's signing the agreement side. Where do you think some of the most common mistakes are, the biggest oversights?
In terms of the non-compete agreement?
Right, with non-compete, yes, thank you.
So that's a good question. That's and that may start sliding over into the legal side of things versus the accounting or valuation side. But, typically there's an argument that the non-compete that you're signing has to be within reason. You couldn't put something in there that says you can't compete in any kind of business, even remotely related to us, anywhere around the world for the next 25 years. That's just completely unreasonable. And most of the time, the attorneys that are negotiating the contract or negotiating the sale of the company will work the non-competes down to where they're anywhere from 2 to 5 years and within a reasonable geographic area. And it's not out of line. As far as any the most common mistakes, I'm sort of just telling you what I see more often than not. I'd probably have to refer to all my attorney friends for the common mistakes.
Basically, it's if you're being unreasonable, that just is no good.
Sure,
for anybody.
Sure.
Right. So I'd really love to hear a little bit about just the why. Like why do you do what you do? I know you really enjoy it. Tell me a little about that.
Why do we value companies? There are all sorts of different reasons to value a company. We've talked today a little bit about intangible assets, and that's one of the many, many tools in our tool belt, if you will. That specifically is surrounding financial reporting. Okay, so for financial reporting purposes, again, if Company A buys Company B, Company A has to allocate the assets that they purchased, or let me actually say it this way. They have to allocate the purchase price that they paid for this company across the various assets that they purchased. That's the better way to say that. So certainly financial reporting. We do valuation work for any number of other reasons, though, whether it's gift and estate tax planning and reporting. You might have somebody wanting to buy or sell a business. We value it for that reason. We do a lot of litigation support, both commercial and family law litigation. On the family law side, if a couple is getting divorced and perhaps each of them own a business, the court will need to understand the value of both of those businesses for purposes of splitting up the marital balance sheet. Commercial litigation, lost profits, damage calculation. Frankly, in the commercial litigation side, any financial aspect, whether it's some sort of forensic accounting piece or what have you, any financial aspect of the litigation we usually are asked to assist with. Sometimes we get calls just to help do some planning. In fact, I was with a client a couple of days ago that reached out to me and just said, hey, listen, we're at kind of a crossroads in our business, and we're not sure where to go. We don't know what the result is going to be in terms of value of our company, in terms of our future cash flows. We're trying to do some modeling in-house, but we're just kind of not coming up with what we think is correct, and so we're going to help them do some of that work. So all sorts of reasons.
When someone meets those crossroads, what do you think are the essential questions they should be asking themselves?
Essential questions they should be asking themselves. They need to really determine and try to drill down to the value drivers of that business. What makes the business tick? What is really going to change the value? If you're a manufacturing company and you're having issues with your efficiency, okay, maybe you've got a backlog problem, what's going to change that? Is it the way your shop's laid out? Is it the fact that you don't have enough space to do the work that you're trying to do? Do you need more staff? What are some of those metrics that can be analyzed and perhaps changed to increase efficiency and as a result increase cash flow and put more value to the company? And that's just an example of probably 100 out there.
Lots of questions. And that's what you like to do. You like to help them think about all the different questions, all the things, make it really easy though, so it's not overwhelming. So that answers all my questions. So final question, I suppose, is just how can someone learn about you, get connected to you, and all the above?
Sure. So I'm in our Knoxville office. LBMC, as you know, has offices in Knoxville, Nashville, and Chattanooga. Nashville is our mothership, if you will, our headquarters, right. And a lot of our valuation folks are in our Nashville office. I run the valuation practice out of our Knoxville office. We've got another lady that works with us that runs our valuation practice out of the Chattanooga office. But I'm the East Tennessee guy. You can go to our website, lbmc.com. That's probably the easiest way to get phone numbers, email addresses. All of my information is there, and I'd love to talk to you. And by the way, phone calls are free. Feel free just to give me a buzz, and we're happy to chat. If we can help in any way, we'd love to do so.
Great. Thank you so much.
Thank you.
That's a wrap for this segment. Thanks for joining us. For more content like this, head on over to lbmcauditaxadvisory.com. Thanks.